I'm Sean Power, Financial Market Analyst at Capital Markets Elite Group, and this is a video to give you a brief introduction to candlestick charts. So let's look at candlesticks. What are candlestick charts? How are they used? How are they constructed? A little bit of background. Candlestick charts originated in Japan. I think they date back to about the early 1700s. They were initially used for understanding supply and demand dynamics, and they basically look to capture four pieces of key information. They were a secret for the Western world probably until around the mid-80s. Then there began an increased focus by UK-based analysts. Michael Feeney, for example, in the UK, he started using candlesticks in his daily work and introduced those ideas to a wider professional group within London. It's just grown year by year. It's gathered momentum, and it's certainly the go-to chart for analysis of financial markets. So that's a little bit of background, but let's look at what makes up a candlestick chart. So a candlestick, which you can see here on my screen, each one of these is a candlestick. A candlestick represents four pieces of key information for the designated time period. So this chart, for example, is a daily. We can go down on MetaTrader 5, we can go to 1 minute, 5 minute, you can go as long as a month. So whatever time frame you're looking at, each candlestick represents that time frame. So within each time frame, we're looking to capture four pieces of key information. We're looking for the opening level, the closing level, the high and the low. And those four pieces of information, when using a candlestick chart, give us a great visual representation of price action for that period. So let's have a closer look at a candlestick here on my screen, and we will look at how they're constructed. So let's look at candlestick. I'm going to let's look at this one here. I know this must be the opening level here, just at the top of that bulk, as it were, and the closing level hit here. I know that because when the opening level is higher than the closing level, the body of the candlestick is red. So that is how we denote whether it's a turquoise in my case or a red in my case. So the body of the candlestick is red. The other piece of information we're looking for are the high. So the high for this period is here, and the low is just about here. Let's see if I can zoom in further. Yeah. So you can see here, so the open was above the close, therefore it's a red body, and these upper and lower edges mark the high and the low. And these upper and lower parts outside of the body of the candlestick are referred to as the upper shadow or the upper wick, and the lower shadow or lower wick. So that gives us a quick snapshot of price action for that period. So we know they opened here at 140.07. It did trade higher, but it has also been a lot lower, and then finally closed the period at 139. So in that period, we know that the sellers have won the battle between buyers and sellers, and they've forced that price lower. And inversely, if the buyers had won a battle in the designated daily period, here, this is the open and that's the close. So that is what makes up a candlestick. That is how it's constructed, the four pieces of key information: open, close, high and low, and we can get instant visualization of the price action for that period, and then we can start combining more than one candlestick together. So we will look at that in future videos. We're going to look at reversal patterns where you're seeing a trend possibly that may be changing. The trend may be altering, so in an uptrending market it may be turning to become a downtrending, and vice versa. We'll look at multiple reversal patterns, that's using more than one candlestick, and we'll look at some continuation patterns. But I hope you found this introduction to candlestick charts useful, and please do make sure you check out the rest of our videos.